Giving USA says the nation's total charitable giving is over $557 billion. And individuals give 67% of that amount, which is more than $374 billion. Giving always makes you feel good, but the Internal Revenue Service, or IRS, sweetens the pot with money-saving charitable tax deductions to encourage more giving. That means there are IRS rules you should know to maximize your charitable giving. This podcast will review 9 tips to give the most and receive the maximum tax advantages for yourself. Welcome back to episode 912 of Money Girl. I'm Laura Adams, an award-winning author, spokesperson, speaker, founder of The Money Stack. That's my Substack newsletter, and host of this podcast with over 43 million downloads. If you enjoy the free content we love creating for you, please take a moment to rate and review the show in your podcast app. And if you've got a question about money, you can leave it on our voicemail at 302-364-0308. And you can always visit lauradadams.com to email me directly and learn more about my books, courses, and the free Money Stack newsletter. All right, so let's talk about tax-deductible donations. A charitable donation is a small or large gift like cash or goods that you make to any individual or organization. However, for a gift to be tax-deductible, you must have donated it to an IRS-recognized charity. Also, you must itemize deductions on your tax return. So remember those two things. It's got to be made to an IRS recognized or eligible charity, and you've got to itemize deductions on your tax return in that year that you want to claim the deduction. And the charitable deduction applies to all gifts you make to various eligible organizations throughout the year. You can typically deduct eligible donations that total up to 60% of your adjusted gross income, or AGI. So that's the upper limit. However, depending on what you contribute, so the type of donation and the type of organization that you give it to, you may be limited to less. However, contributions exceeding any annual limits can be carried over to future tax years for up to 5 years. So, you've got a little bit of leeway there. So let's go through 9 tips that you can use to maximize your charitable giving. Number 1 is to give to qualifying organizations. As I mentioned, they do have to be approved. While you can give to any person or group you like, you can only claim a charitable tax deduction when an organization is tax exempt, as defined by Section 501c3 of the IRS Code. And that's going to include most public schools, religious organizations, and museums. Those are going to be automatically qualified as tax exempt. But if you're unsure, you can ask an organization for documentation of their status or look them up on the IRS Tax Exempt Organization search tool, and I'll have a link to that in the show notes. Note that specific donations, including those to individuals, political campaigns, business associations, and for-profit organizations are never tax-deductible. All right, tip number 2, know the value of your donations. Now, if you donate cash, you're going to know exactly the amount you give. But it can get a little complicated when you donate property, like clothes, household possessions, or vehicles, because you can only deduct its fair market value at the time of your gift. Plus, if you get something back for a gift, like you make a donation and then you get merchandise or you get tickets to an event, you can only deduct the amount that exceeds its value. When your non-cash contributions total more than $500, you must submit IRS Form 8283 with your tax return. And if your non-cash donation is worth over $5,000, you must also have a professional appraisal, except when you give publicly traded securities. They have values that are publicly known and clear. And if you want to learn a little bit more about determining the value of donated property, you want to look at IRS Publication 561, and I'll have a link to these in the show notes. Now, what about donating your time? Maybe you don't donate cash or goods, but you want to donate your time to a qualified organization. Well, in that case, you can deduct any out-of-pocket expenses like fuel or transportation costs that were necessary and unreimbursed. Or you can claim a standard mileage deduction of 14 cents per mile to calculate your contribution. For example, if you drive 100 miles to do charitable work, like attending a charitable event or bringing items to a donation site, you could claim a $14 deduction. That would be 100 miles times 14 cents. Plus, you could add in any tolls and parking fees. But you can't deduct general vehicle maintenance or the value of your time. Tip number 3, document your donations. You want to keep good records of your tax-deductible donations and get a receipt from the charity when possible, no matter the amount. However, if your cash or non-cash donation is worth more than $250, the IRS requires you to have a written letter acknowledging the charity name, the amount of your gift, and the date. Tip 4. Donate appreciated non-cash assets. So let's say you have non-cash assets like securities, stocks, or real estate that you want to donate. Consider giving them directly to a charity instead of selling them first and then donating the cash. That's because if you owned them for more than a year, you would avoid paying capital gains tax, which could be 15 or 20% depending on your income. So that's a little strategy to make sure that you are going to donate appreciated assets directly to a charity. But the opposite is true if you have assets that have loss value. So this is tip number 5, is to donate assets at a loss. If your securities like stocks or ETFs are worth less than their cost basis or what you paid for them, you could sell them and donate the cash to claim a charitable donation. So this strategy is called tax loss harvesting. This is where you use capital losses to offset capital gains or income up to $3,000. And if you have losses over $3,000, you can carry them forward to offset gains and income in future tax years. Tip number 6, contribute to a donor advised fund or DAF. A donor-advised fund is an investment account you can open to support charitable organizations you care about. When you contribute cash or non-cash assets to a DAF, you can claim an immediate tax deduction and invest the funds for tax-free growth. Then, you give the funds to a charitable organization when the timing is right for you. I mentioned that there are annual deduction limits for charitable gifts. For cash donations, the maximum is up to 60% of your AGI. Now, when you give non-cash gifts that you've owned longer than a year, including donor-advised funds, the annual deduction limit is up to 30% of your AGI, and you may carry over any excess donation amount up to 5 additional tax years. Tip 7. Meet the annual deadline. For a donation to be tax deductible, you must make it by the end of the corresponding tax year. For instance, you have until December 31st, 2025 to make donations you want to claim on your 2025 tax return. If you mail a check for a donation, the day you send it is your donation date, not the date that it gets received by the charity. Likewise, the day you charge a donation on a credit card is the donation date, not the date you pay the monthly statement. And if you donate securities like a stock, the donation date is the day it gets transferred to the charity. Number 8, itemize your tax deductions when possible. Every year, you can claim a standard tax deduction for your filing status or list your deductions on Schedule A of Form 1040. This is called itemizing. When your allowable deductions exceed the standard amount, you're better off itemizing. However, if your total deductions are less than the standard deduction, your charitable donations may give you lots of good karma, but they're not going to give you any tax benefit. As I mentioned, you've got to itemize deductions to deduct any charitable contributions. I know that tracking your deductible expenses and itemizing them on your tax return can take longer than just claiming the standard deduction, but the tax savings can be well worth it. So definitely keep track of those expenses, and then you get to choose which method you want to submit on your tax return. And number 9, bunch donations in one tax year. If you don't have enough charitable donations and other allowable expenses to itemize on your tax return, consider waiting to make additional gifts until a future tax year. Combining contributions for multiple years into one tax year is known as bunching. That could give you a larger deduction than claiming 2 or more years of standard deductions. So these are just a few ways to amplify your generosity when you want to share a little or a lot of your wealth. If you want to make charitable giving part of your financial plan, I want to encourage you to work with a financial advisor who can help you use advanced strategies for leaving a legacy and cutting your taxes. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we have a terrific team that I want to thank. Steve Rickyberg audio engineers the show. Brandon Gaches is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.